Okay, let's rewind the clock to 2019. Back then, pretty much everyone was absolutely convinced that GameStop was toast. I mean, the headlines were just brutal, painting this picture of a company on life support, a relic from a time of physical media. The consensus was crystal clear. It was only a matter of time before they shut the doors for good. And this was the line you heard everywhere, the next Blockbuster. It was this simple, really powerful story that just seemed impossible to argue with. But what if that whole story was just wrong? See, in mid-2019, a super detailed 50-page report came out that made this powerful contrarian case, that the market had it completely backwards, and the stock was actually fundamentally undervalued.
And that's exactly what we're going to do here. We're going to push aside all the memes, the squeeze, everything that came later. We are going straight back to 2019 to walk through that original bull thesis, and we're going to focus just on the data that flew in the face of the market story of impending doom. All right, let's get into it.
So here's how we'll break this down. First, we'll look at the business model that everyone seemed to misunderstand. Then we're going to tackle the big market myths one by one. After that, we'll dig into the actual valuation case, then cover the risks and catalysts, and we'll wrap it all up with a final reflection on what it all meant.
Okay, so the very first, and maybe the most important part of this 2019 bull case was this idea that you had to stop thinking of GameStop as just one single dying company. The whole argument was that you really had to see it as two separate businesses, both of which were getting hammered by the same negative story. Let's break those down. So first, you had what the report called cash cow. This was the legacy side of things, new and pre-owned software. And yeah, it was declining because of streaming. But, and this is a huge but, it was also incredibly rich with cash. Then you had GrowCo. This was the stuff with higher margins like accessories and collectibles. In this part of the business, it was actually growing. The market's big mistake was pricing both of these as if they were just nosediving to zero together.
And this slide just lays it out perfectly. Over on the right, in red, that's your cash cow, the old-school software business, pulling in a massive $4.5 billion. But now look to the left, in orange. GrowCo, the accessories and collectibles, brought in an incredible $3.8 billion. This was not some tiny little side project. This was a nearly $8 billion company where the market was obsessed with the declining half and completely ignoring the profitable and growing other half.
Okay, so with that two companies idea in mind, let's start tackling the big myths head-on. This is where we really separate the popular story from what the financial reports were actually telling us.
And here it is, the big one, the comparison that just shut down any and all debate. GameStop was simply the next Blockbuster, right? A dinosaur just waiting for that asteroid. It sounds so convincing, but the moment you look at the balance sheet, the whole thing just falls apart.
And this chart just shows you the core difference beautifully. Blockbuster was drowning in debt. GameStop, on the other hand, had something like $500 million in net cash, and it was still generating positive free cash flow. This was not a company teetering on the edge of bankruptcy. Not at all. Its financial situation was in a completely different universe.
Okay, myth number 2 was practically an article of faith for anyone bearish on the stock. Digital streaming was going to make physical games obsolete overnight. The thinking was pretty simple. Why would anyone ever buy a disc again when you can just download the game? The end wasn't just near, it was right here, right now. But again, that story was just way too simple.
The reality, which you can see in the data, was a lot more nuanced. I mean, for sure, the market for digital games and downloadable content, that's the light blue bars, was growing, no doubt about it. But the physical market, the dark blue bars, was still enormous. It was shrinking slowly, not just falling off a cliff. Plenty of people still wanted physical copies for their collections, for gifts, to trade them in. The two worlds were just coexisting.
And this one leads us to another really broad, sweeping story that was popular back in 2019, the Amazon effect. The narrative was that e-commerce giants were just this unstoppable force, and any specialized brick-and-mortar store, whether it was books or electronics, was in their way and was gonna get crushed.
But here's the actual data. Just look at that blue line. Despite the rise of e-commerce, GameStop had kept this remarkably stable and significant piece of the global packaged games market. It was holding its own in its most important category. It wasn't getting wiped out at all. It was actually proving to be pretty darn resilient.
So this is a really crucial point. There's a huge difference between a decline with a ton of debt and a decline without it. Yeah, the legacy business was shrinking, but when a company has low debt, it can manage that decline gracefully. It can cut back on spending, shrink its inventory, and actually generate cash on the way down instead of just spiraling into bankruptcy.
And that brings us to the final myth, that it would be better to just sell everything off and shut the whole company down. You know, it sounds logical on the surface, but a fire sale liquidation like that is incredibly destructive. You'd have to sell inventory at massive discounts, you'd have tax problems. The value of the company as a living, breathing, cash-generating business, even one that was slowly shrinking, was much, much higher.
Okay, so we've taken apart the popular myths. Now let's get to the real meat of the 2019 bull case, the valuation. What was the stock price actually telling us about the company's future?
This number is just staggering. This is what the market was saying. When analysts reverse-engineered the stock price, they figured out that for the valuation to make any sense, you had to believe GameStop's revenues would drop by 20% every single year forever. Not just for a couple of years, but forever. It was just an absurdly pessimistic bet, pricing the company for a total freefall that was way worse than any reasonable guess.
And this chart, they call it a valuation football field, basically sums the whole thing up. That little orange bar on the bottom left, that's where the stock was actually trading. All the other bars show you different ways of valuing the company, even using super conservative numbers, like a 10% revenue decline every year and shrinking margins. Even in those worst-case scenarios, the analysis showed the stock was seriously undervalued. The gap between the price and its fundamental value was just enormous.
Now, it is really important to be super clear about this. This original 2019 thesis was not some to-the-moon, diamond hands fantasy. It was a sober, value-based argument that knew there were major risks alongside those potential rewards. The report laid out exactly what could go wrong. The biggest risks were actually internal, that the management would just make dumb decisions with their money. You know, like making a terrible acquisition or spending way too much on store redesigns. There were also risks like activist investors fighting with each other or a new management team just messing things up. These were all very real possibilities.
But on the other hand, there were these really clear triggers that could unlock the stock's true value. The company could use all that cash for massive share buybacks, it could be sold to a private equity firm, or it could pay out a big special dividend. And then there was the last point, which, looking back, is just incredibly insightful. Even back in 2019, the report pointed out that the extremely high number of people betting against the stock was creating the perfect setup for a potential short squeeze.
So let's just pull it all together and think about what the core lesson is here. When you really looked past the headlines in 2019, what was the real story? Well, it was about this huge gap between a popular, easy-to-understand myth and a more complicated but data-driven valuation reality.
And this right here is the main point of the whole thing. The bull case was never about GameStop suddenly turning back into a high-growth tech company. No, it was about something much simpler, the timing of its cash flows. The whole thesis was that the company could generate a massive amount of free cash for years before its old business really disappeared. The market was pricing it for immediate death, but the reality was a slow, cash-rich decline. Of course, nobody could have predicted the sheer insanity of what happened next, but all the ingredients were right there, hiding in plain sight. And it leaves us with a pretty fascinating question to think about today. What company or what industry is currently surrounded by a powerful, widely believed negative story that the numbers just don't back up? What is the 2019 GameStop of tomorrow?